Welcome back. Alrighty then, let's move on with exchange rate risk, part of the risk premium. Let's get some more details about exchange rate risk. Okay, let's look at an example. A U.S. investor buys 100 shares of Mitsubishi Electric at 1,050 yen. This is a Japanese company that is located in Japan, and it trades on the Japanese market for yen. So if an American investor wants to buy it, then what we have to do is we have to take our dollars and exchange our dollars for yen, and then invest the yen to buy the stock. That's what has to happen. All right, so when we make our investment, the so the stock is trading for 1,050 yen, and at the time the yen-dollar rate is 135. It takes $135 to buy 1.35 yen. $135 to buy yen. All right. 12 months later, the investor sells it for 1,200 yen. Okay, so we're buying at 1,050. A year later, we sell it for 1,200. Not too shabby. Okay, we've made a nice return. Okay, but now the yen-dollar rate is 150. 1.5. Now takes $1.5 to buy a yen. So we have two separate things going on here. One is the change in the stock price. The other is the change in the yen-dollar exchange rate. And they're not necessarily related. Okay? The change in the stock price didn't have anything to do with this change in the exchange rate. All right? All right. It now takes more yen to buy a dollar, or more dollars to buy yen. Okay, so the yen has weakened against the dollar. Okay? It takes more yen to buy $1. That's what this is telling us. Okay, so the yen has weakened. So we have the yen and we have the dollar, and now the yen has gone down, the dollar has strengthened. Okay? So the yen return, if we were trading just in yen, we made a 14.29% return. Pretty nice. Pretty nice. Okay? But to determine our dollar return, if we sell the stock and now we want to convert our dollars, our yen, back into dollars and take our money out of Japan back into the United States, okay? The yen has weakened, so we will not receive as many dollars for the yen that we generated by selling the stock. Okay? So you have to convert the yen values into dollar values. Let's look at this. The ending dollar value of the stock investment is 1,200 yen divided by $150, $8. Okay? The beginning dollar value of our stock was 1,050 yen divided by $135, $7.77. You starting to see what I'm talking about here? The rate of return to the U.S. investor is only 2.86% because the yen weakened while we were holding Mitsubishi Electric stock. Now, if we did not convert our yen back into dollars, but we reinvested our yen into another Japanese stock, we would get that 14.29% return. But anytime we want to convert our yen back into dollars and bring it back to the United States, we could be subject to a currency or exchange rate problem. Okay? So the dollar return is lower than the yen return because the yen weakened by 11%. So the stock went up, but the yen went down. Okay? And this is exchange rate risk. All right, let's look at country risk. Let's see how far we're going in this. We're going all the way to slide 39. So we got a ways to go here. Just wanted to double check that. So let me double check this video, make sure that we're going okay. And we are. Everything looks good. Let's see. Why does that camera say? Why does it say camera no? I don't know. Hopefully we're good. Hopefully we're good. Okay. All right, country risk. This is uncertainty of future cash flows due to political or to economic instability. All right, so you look around the world and you see how unstable governments are. You see what happened in Ukraine. You see what's going on in Syria. You see what's going on in Iran. You see what's going on in Venezuela. There's a lot of uncertainty. And so when you're making international investments, you have to recognize that there could be some serious problems, political or economic problems, in the countries in which you invest. Okay? All right, so you have military coups, you have regional conflicts, you have lack of law enforcement. Okay, can you say the Central American countries? Lots of law enforcement issues there. Okay, nationalization of private industry. What does that mean? It means the government takes over private business, forces the private owners out. Okay, all these things happen around the world. Don't happen in the United States because our system is strong enough to keep this from happening. All right, so let's build our required rate of return. All right, so we'll start with the real interest rate on the Treasury bill of 3%. So we're going to build up our required rate of return. What will it take for us to make a risky investment? So we'll start with our required rate, our real rate of return of 3%, in expected inflation rate of 2%. So if we're going to make a risky investment, we're going to have to get at least 5%. Okay. Then the long-term real return on all stocks is 6%. So we're going to have to get at least 6%. So let's say we're looking at buying stock of a private company, and so we're going to have a liquidity premium of 5 percentage points. So now we're up to 11%. Okay? The company has a limited product line. This is business risk. That's another 5%. Okay? What I mean by that is they don't sell a lot of different products, and what if a competitor or a new type of product comes into the market? Okay? So now we're up to 16%. Okay, that's the 6%, the 6% on all stocks plus a liquidity premium of 5%. I know we started with the 3 and 2%, but that's a risk-free rate. A risky rate is 6%. So I have 6% plus 5% plus 5%. That's 16%. Okay, concentrated customer list. That's also business risk. Okay. That adds another 5%. That means we've got 1 or 2 customers that are large, and if we lose them, we're in trouble. So you're learning something about business right now, folks. If you're looking at buying into a business, these are things you better look into. Okay? So now we're at 21%. Required rate of return to take this big risk. Okay? The company is in a cyclical business, and that adds 2%. That means it ebbs and flows with the economy. Okay? As opposed to a stable business. So now we're at 23%. Okay? The company does not have audited financials, so you don't know if those financial statements are accurate. That adds another 5%. So where are we? 23, 28%. I think we're at 28%, something like that. The company has a lot of debt. You're buying that company, you're taking on the debt. That adds another 3%. Now what are we at? 31%, I think, something like that. Okay? I missed something. So we're at 33%. 33%. Okay? All the things here, each of these represents a different risk, and these are components of the risk premium. Okay? So in order to justify making this risky investment, we have to earn 33% annually on our investment. And you're saying, wow, that sounds awfully high. Well, if you talk to venture capital firms that specialize in making risky investments, their required rate of return for making those risky investments right around between 30 and 40%. Okay? That's the kind of return they look for in order to justify making these risky investments. So note that since the real rate of return on stocks is included, and the real rate of return includes a risk premium above treasuries, you start with the real return on stocks and then add all of the other risk premiums to get the required rate of return. So you start with the real return on stocks and then add those other risk premiums. Okay? All right. So there is a more popular way than looking at the required rate of return. And remember what the required rate of return is. It's your discount rate. So you put your cash flows in the numerator. You put 1 plus the required rate of return in the denominator. You find the present value of the expected future cash flows, and that tells you what a fair value is for stock price. There's another way, and we looked at that at ManFin. In our ManFin classes, we looked at finding the present value of expected future cash flows to determine the value of a stock. Now we're going to look at the other way, the multiples. The multiple, okay? And the multiple determines how expensive a stock or a market is, okay? Multiples, as opposed to the required rate of return, okay? Frequently used multiples include the price to sales ratio, the price to EBITDA or cash flow ratio, price to earnings ratio, price to cash flow ratio. So it depends on what type of cash flow you want to look at, EBITDA or cash flow. Cash flow from the cash flow statement, like free cash flow, a little different from EBITDA. Okay, if you're a finance major, you got to know these accounting terms. And price to book value, and book value is equity, common equity value per share. Okay. All right. So a multiple represents how much people will pay on a per share basis for each dollar of fundamental. What are fundamentals? Well, sales, EBITDA, cash flow, earnings, and book value. You got to forecast the fundamentals. Then you have to forecast the multiples. Remember that from chapter 7, forecast, and actually also from chapter 3. So you have to forecast the fundamentals and forecast the multiples. So the multiple basically is the reciprocal of the discount rate or required rate of return. We'll look at that. All right. So the multiple is the inverse of the required rate of return and vice versa. For example, if the required rate of return is 10%, then the multiple is 1 divided by 10%, or 10. So notice that as the discount rate goes down, the multiple goes up. The discount rate goes down when people are optimistic. The risk premium goes down, the discount rate goes down, the required rate of return goes down. And if the required rate of return goes down, the multiple goes up. When people are optimistic, they will pay a higher multiple, higher price for these fundamentals. When people are scared, what happens to the multiple? The required rate of return goes up and the multiple goes down. So it's really, really important. One of the most important things you need to learn from this course is the relationship between interest rates, growth, mood, and the required rate of return and multiples. Okay? You need to understand those relationships. Very important. Okay. So if the required rate of return is 20%, the multiple goes to 5. Okay, so you can see when the required rate of return goes up, the multiple goes down. Let's see, okay, last slide in this clip. Therefore, the more confident investors are, the smaller the risk premiums and the smaller required rates of return are, and the higher multiples are. Okay? The more frightened investors are, the higher the risk premiums and the required rates of return are, and the lower the multiples are. All right, and here's a chart of the PE ratio, a multiple for the S&P 500. These are multiples. Look at this. Look at how volatile this chart is. Much more volatile than the earnings chart. Let's see if we don't have the earnings chart. I'm going to have to get the earnings chart to overlay it so you can see that the earnings are, they go like this. The earnings go like this, whereas you can see what happens to the multiples. What does this reflect? It reflects primarily interest rates and mood swings. Okay? People being scared. Back in the 30s, you can see that multiples went straight up. People got very, very scared. I'm sorry. This is 29. This is when people got super, super confident, and then the multiples went straight down. People got scared. Anytime you see multiples do that, either interest rates are going up and or people are getting scared. Confident, scared. Confident, scared. Confident, scared. Confident, scared. Ooh-wee, very confident, very scared. Okay? All right, so that is the end of this clip, and we'll go on to the next clip, which will cover slides 40 through 49. See you next time. Peace out. Shalom.